Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started.
Welcome to another episode of Kaizen Time. I'm joined by Pierre, Senior Manager and Mentor. Pierre.
Hey, Mark. How are you?
I'm well. I'm estimating that I'm well.
It's a good estimate.
Yeah.
But you can generally tell. I mean, you're not a doctor, are you? I didn't think you were.
I am nowhere near a doctor.
Pretty good estimate. Okay.
Yeah. But here's the thing, because we've talked about estimating. And actually, in a previous episode, we talked about how accountants, there isn't really estimating. You have credits and debits, right?
That's all there is.
And that's why Pierre tells me it's the easiest job on the planet.
No. Accounting is the easiest thing on the planet. People are afraid of it, but they don't.
But being an accountant isn't.
Being an accountant can be difficult sometimes.
Okay. But being a doctor is hard because a cough could be insert list of reasons, right? You could go on WebMD and it'll tell you cancer, right? So getting back to estimates, why do you pay estimates in taxes?
Yeah. So obviously we've talked about many times before, taxes are not going anywhere. We do have taxes. If you're making
there will
money,
always be taxes.
you're going to have taxes.
No matter where you go.
And if you, we were just talking about one of your friends comes up and tells you, hey, I have to pay all this tax. I have to pay all this tax. First thing that comes to my mind, are you ready for paying that tax? Are you actually going to pay that tax? Or are you not ready to pay that tax and you owe the tax and now you're in trouble and you haven't done anything to prepare for it? So estimates help you take care of that problem. One of the most common estimates that are out there is our withholding on our W-2s, right? We all have that. You think about if you did just your W-2 income and you get to the tax return at the end of the day and you see that you owe, I don't know, $20,000 in tax. But that's not what people think of. They think of the bottom. Did I get a refund or do I have to pay? And that number's $1,000 or $2,000. But the tax that they actually paid could be $20,000. They just had $19,000 or $21,000 withheld. They made estimates in each paycheck. Okay, so we all focus as taxpayers as that bottom line. Am I getting a refund or am I owing? You really need to be focusing on how much do I pay in tax and how do I prepare for it. So if we didn't do withholding, people would be losing their minds on tax day when they had to come up with $20,000. Now they only have to come up with $2,000 and they lose their mind, right? Imagine if you had to come up with 20. So same thing with estimates for businesses and personally.
And that withholding is, I don't want to say essential, but it is sustainable. Okay. Having a little bit taken out every time. And people bring this all the time up as far as like saving, 401k or an HSA. It doesn't really hurt you too much. Just a little bit out. You got some wiggle room, right?
Yes.
And in the back end, you say, one day I'll probably be able to retire, right? So this is the same thing in many ways, that withholding. It helps you just get the taxes taken care of so you don't have that huge hit, which is not sustainable.
So that's one of the other things. People view the tax return as the finish line. Estimates are running it during the year. I think I'm going to owe $20,000 this year. Let me make a $5,000 payment here, a $5,000 payment here, a $5,000 payment here. When I have the cash, so I just sold it. I didn't spend it on a new Ducati or anything else. Now I have the cash. I can make those 4 payments rather than waiting till April and, March, the boiler went, or February, I don't know, we had to buy a whole new machine and now I don't have any cash. It's all about planning and preparing for that tax bill.
Yep. And again, we've talked about it before that some businesses, they are cash heavy during certain times of year and then other times they're not. Yeah. I even do the same thing with my own business where it'll be, okay, we're doing great. Hey, lots of events have been done. Hey, I'm going to pay all this, my mid-year, right? What are some key dates to really focus on with tax withholding?
So pretty standard, April 15th, September 15th. June 15th, September 15th, and December 15th. Sorry, individuals, it's January 15th. So 4 times a year. That never changes, except tax day this year was on a Sunday for corporations, March 15th was a Sunday. So we actually got to the 16th.
Okay.
But if you always think March 15th, April 15th, June 15th, September 15th, and January 15th, those are your 4 estimate pay days.
Okay. And you don't have to pay these at all.
No,
in theory, you don't have to. But it is recommended. And again, depending on your business and your tax situation, or if it's your full-time business versus, hey, this is my part-time side hustle, that can dramatically affect it, right? You may not have any business for the first quarter, and therefore you ain't paying any taxes, right?
That is correct. You can annualize your income. Mm-hmm. The IRS allows you to do it. But the IRS does want you to pay it when you have it.
Bingo.
So there are penalties if you don't make estimates based on prior year's or current year's tax. You can pay 100% of prior year's tax if you're in a lower income bracket, but if you're in a high income bracket, you have to pay 110% of prior year's tax. Or you can pay 90% of current year's tax. So whichever one of those works for you, you can choose to avoid any penalties.
What is this safe harbor method?
That's exactly the safe harbor. Great follow-up question. Safe harbor says as long as you pay 110% of prior years, or 100% if you're in the low enough bracket, 100% of prior year's tax or 90% of the current year's tax. So one year you sold a big property, right, for $1 million, and the next year you don't have that sale, I try to aim for the 90% of the current year's tax, then paying 110% of last year's tax where I sold a building. Mm-hmm. So there's always more to them. But generally, you pay your tax that you paid last year, you're going to be in good shape. That's why withholding works so well. Mm-hmm. Hey, make sure you had enough withheld. Problem can be with individuals. Your spouse's employer doesn't know that you have a W-2 as well. Mm-hmm. So they think your family's only making this much money with a family of 4. Mm-hmm. This one thinks you're making 4, but you guys actually have twice the income or however much your combined income. That's how you can get behind.
I can see that where let's say one person's unemployed for a while and then all of a sudden, boom, they get some slam dunk job kind of thing.
Yeah.
That dramatically changes. Yeah. Well, whether it's a personal person, right? Hey, my personal tax return versus my like a business, it's all about what's sustainable. And we talk a lot about, growth. You could also talk about decline in the same way, but you'd rather it be steady instead of just this huge shift that's not really manageable, right?
A huge chunk.
Yeah. Yeah. And that's exactly what happens when you sell these buildings that are worth millions.
Everything's worth $1 million now. Yeah. So it's a classic example. How do you eat an elephant? One bite at a time. You can't eat the whole thing at once. Now, some people do have enough cash that they can, but why give yourself that headache? Mm-hmm. Plan for it, prepare for it, make your life much easier.
And let's be honest, the IRS prefers it that way, right?
They do, yeah. You'll get less notices from them if you do it that way.
Pierre, can you go into a little bit more detail on that? like if you sell this $1 million business or buy a new building, sell a building, is that like a red flag for them where they're
certainly
more
the IRS,
interested?
Yeah, they're more interested in higher dollar things that go on, right? Your parking ticket for $35 and you try to deduct it when you're not supposed to. That's not the end of the world. But you don't report the income from your $1 million sale of your building. That's going to be a red flag. And they're going to go where they can get a lot of bang for their buck. That being said, if you're being audited and while they're auditing you, they see that you tried to deduct your $30 ticket, they're going to get you on that
They'll
one.
get you on top of that.
They're going to get you on that, but that's not going to trigger it.
Okay. Fixing issues now. What's the best way to do it?
Yeah. So right after you did your tax return, you had some pinch points. Mm-hmm. Where there was, we didn't plan enough. Maybe we should have bought another vehicle. Maybe we shouldn't have bought another vehicle. Now's the time to recap what we did last year. Make sure you look at that return. A lot of people get that return. They think, I'm done. I don't have to do anything. It's like going to the doctor. The doctor says you're overweight. That's great. Okay, now I know the problem. Now do something with that information. Or underweight, eat more or eat less. Same thing with your tax return. Now that you have what happened last year, maybe it took a long time, classic case, somebody will buy a piece of equipment and not turn in the financing paperwork. And then it comes to, you buy it in June. Mm-hmm. Now it's March 15th and your accountant is barking at you, hey, I need that piece of information so I can take the deduction for you. Mm-hmm. Now you're trying to find it because you put it in your accounting system, filing shoebox or whatever you use.
Shoebox, I was about to say, yeah.
And you can't get it. Get that information in during the year so you can plan and not have a surprise or be digging around for something that you can't find. The good thing is a lot of information is available online and you just have to go get that email or whatever, but stop doing that. Learn what caused you pain from this tax return. I didn't pay enough in. I paid too much in. Take that information and use it for next year because we have 3 more payments coming up. We actually have April, right? Well, when this comes out, we'll have June, September, and January left to pay.
And realistically, Pierre, this is what you pay the accountant for, right?
Yeah.
Hey, okay, I got all this information. Looks cool. Where did I really screw up? Right? Okay, how can I get this cleaned up? What else needs to be done? How can I prepare myself? Right?
And what's happening this year versus last year? Last year we sold the building. We're not doing that this year. Or last year we didn't sell the building. Gosh, we're selling one of our buildings this year. Or we're buying a building. All that can change those estimates.
And that's exactly where I wanted to hit too, Pierre, because like, hey, should I sell this building? That's a really good question to ask before you sell the building.
That's a great question. How much is this going to cost me? Last year we had a couple of clients that wanted to sell their business. And one of them was making $1 million a year. When it came down to it, after taxes and everything that was coming out, he would make what he would make from selling this building in 3 years. He's like, I can do this for another 3 years and then sell my business then for that same amount. So without that planning vision, he might have sold it and he might have got a lot less than he thought he would without doing that analysis.
And that analysis is important because the state of the economy matters when you're doing that. The the state of private equity matters. And because how much your business sells for, I think of this more like cars. The value of a car is really dependent on the demand, but also who's buying. If no one's buying it, it could be the nicest car. It could be a Lambo that's whatever
in the snow.
Yep. But the simple fact is, if no one's buying it for that, well, then it's not really that valuable.
So it's also about being able to plan for it in case something does go wrong with the economy. You can say, well, here's why I have this set up. So it's not to be reactionary, it's to be preparing for the upcoming year and tax returns and new hires. And
and at a bare minimum, it's being knowledgeable. Because if you don't have any knowledge, you really can't prepare at all. Right. So let's talk about this kind of preparing and planning ahead. And as we kind of wrap up, retirement contributions, all that stuff, is that all part of this mid-year taxes? Is it separate? How does it work?
It's both. Now, there are some that you can tweak it right at the last minute. You can put some contributions into your IRA if you don't have one. You can do a profit sharing plan component if your company has one. You can add to that. And that you don't even have to pay that until you file your return. So you can make that pension match September 14th. If you're going to file a return. So you had that money the whole year to do or gather it to make it and put it on last year's tax return. There aren't many things like that. But going forward, if you say, gosh, we should have put a 401k plan in, you cannot do that in March. You can do that in March for this year, but not for last year. Right. So really, you want to talk about that during the summer, and you have up until about September to put in a full-blown retirement plan into your company. So you can't just decide that at the end of the year. There are some plans that you can, simple plan. You can always do an IRA right up to filing the tax return. But if you really want to take advantage of your company's making a lot of money and you want to plan it out to put some money in what I call your other pocket, not Uncle Sam's pocket, and you can afford it, how much can you afford? That planning should happen right now after tax season to go forward to next year. Gosh, we paid a lot in tax. What could we have done? 401k plan could allow you to put away a lot more money. You have to pay the employees too, but a lot less went to the government.
Exactly. And that's stuff that will continue to grow. So it's ready for you when you retire.
Yes. It's out of your income each year until you retire.
And then it's all yours.
Well, so go to pay tax in unless you put it in a Roth.
Oh. Anything else you want to add, Pierre?
I think that's it. The key is, use last year's as a guide, plan for this year's activity to see what you can make go better during this year.
Perfect. Thank you, Pierre.
You're welcome.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.